All right, guys, it's Justin Goodbray with Financially Simple. So we're live. It is Friday, time for Stump Justin. So I have been receiving emails and tweets and Facebook messages and LinkedIn messages all week long, and I have a ton of questions this week. A lot of good questions. I can't wait to share them with you. For those of you who are joining us live, I'm watching people come in right now. For those of you who are joining us live, if you have a question that you're like, dude, I want to see if I can stump Justin with this question, now's your chance. So I want you to drop it into the comment section below. I got to tell you, before we get started on the questions, if you've watched my personal Facebook feed, I'm actually going to drop a picture into the comments afterwards. I've had this little crazy mouse that got into my car, believe it or not, this week. I was on the way to work a couple days ago. The temperature in East Tennessee dropped over the week, and I think it was like 54 degrees. And as I'm driving on the road to work, I look up, and lo and behold, a mouse runs across my dashboard. I'm like, was that a mouse? And then the little mouse jumped into the seat beside me. It was like there with his little paws looking at me, chewing on something. I don't know what it was, looking at me as I'm doing like 70 mile an hour down the interstate. The mouse is standing beside me looking at me. So I get to the office. I was laughing about it, took a photo, shared it on Facebook. Leave my doors open on my car all day long. My wife drops the kids off here at the office, and we're getting ready to head home. We're about halfway home, going down the interstate. Here comes the mouse. It comes out, runs around the car. The kids are screaming. They're all up in their seats. And I got to tell you, I am chuckling at the top of my lungs. I am literally laughing. I can barely see the road. So I said, we get home. We vacuum out the car. We open the car up. I don't think the mouse is in the car anymore. I don't know how it got in there. But let me tell you, you've not lived until you've had a mouse in your car. So we had a lot of people jump in. I hope you like the little story. Give you some levity on a Friday afternoon at 4:30. But if you have a question, now is your chance to jump in and ask Justin. And I have a ton of questions that's come in this week. And I want to read them to you. Some of them are really, really cool that made me think a little bit on some of these. But I want to read you some questions. And maybe this will give you a chance to think about some how to stump Justin questions. So if you have a financial question, shoot it at me. Drop it in the comment section there below. Now's your chance. If you are able to stump me, if you're able to ask a question that I can't readily give you an answer to, then our team has a special gift for you. We'll follow it. Our team will get with you, and we'll give you something really cool. So I want to jump into these questions right here first. And we've already got one coming in. So let's see. Let me come back to that one right there. That's an interesting question. All right. So one question I got this week is this. What is goodwill? And the question has it in parentheses. What is goodwill in the sale of a business? Okay. And then how is it calculated? So we can deal with that at multiple different levels. So let me, Goodwill, we've probably seen the movie Goodwill Hunting, I think it was. Maybe Matthew Damon inside there. I can't remember. Anyways, in a business, we use this term goodwill, and the technical term, we often say it's self-generated goodwill. What goodwill is it's a value of a company, or it's a method in the company that is not like buying water bottles. So let's say we have a company and we're manufacturing water bottles, and we have machines that make the plastic, and we have machines that filter the water, and we have machines that print the labels on this purified drinking water bottle, okay? That would be an asset that we would sell in this company. So if we were selling our water bottle making machine, if we were selling our water bottle making company, we would sell the whole company, which produces all these little components, maybe the plastic bottles, maybe the water, maybe the purification. We would sell the processes. We would sell the patents. We sell a lot of things. One of those components in the sales price of a company is a thing called goodwill. Goodwill is those intangible assets or non-tangible. I use the word intangible assets. In other words, it doesn't qualify as like a piece of equipment. It doesn't qualify as maybe the filter or the plumbing parts to put the water in the actual water bottle. So goodwill is going to deal with all those intangibles. How is it calculated is the question. And that is an interesting, very dynamic question. So we call it intangible assets or goodwill, and it can be calculated a number of different ways. I'll give you an example of a real case that I'm working on actively right now. I'm dealing with a dentist who wants to buy a dental practice. And I'm looking at the appraisal of the dental practice, and the practice purchase amount is for $800,000. That's how much the young dentist wants to, or that's how much the older dentist wants to sell the practice to the young dentist for. And that $800,000 value, only $200,000 of it is the actual equipment or the dental chairs, the dental x-ray machines. The majority of that is goodwill. And so that's going to come into like the patient records, the name of the company, the non-compete agreement comes into that. Sometimes attorneys separate it out. Sometimes they don't. Sometimes they include non-competes as part of the goodwill. But it's all the intangible assets. So the way it is calculated is on a case-by-case scenario. And there's basically a couple of underlying things which drive the value of goodwill up. And I use the 4 C's, and I'm going to miss these, I think, but it's customer capital, human capital, social capital, and I think it's technological capital. The best way to generate goodwill in your business is to work on your systems. So you can work on systems like your ERP system. That's your your bidding system, where you're going to bid out credit bids. Your CRM system, which keeps your name of your customers and all their contact information. It could be your hiring system. So if you want to increase your goodwill of your company, you can work on your systems within your company. So what is goodwill? It's the non-tangibles or the intangible assets of the company that you're selling. So it doesn't mean the machines. I'm going back to my water bottle. It's not the machines that fill the bottle up. It's the actual customer names. It's the way the world sees your company. Okay, so it's all the intangible assets, and it's calculated various different ways. I actually use software that calculates it for our clients. We have some really cool software that I can tell you almost exact value of your company and how to increase that value over time. I've got a Flooding Love. This guy kills me. I know who he is. If I could get my hands on this guy, he like works all week to try to find out something from me just to harass me. Whenever I get my hands on him, I'm going to, Anyways, Flooding Love, he asked, I just learned that in some court cases, a financial expert witness is called in. What their purpose? What is their purpose? I think is what it meant to be. And when would they be used? So that's an interesting question. About a week and a half ago, I was actually, or over this year, I served as an expert witness on a case. So financial experts come in whenever the attorneys need to motivate one side or the other to make a decision. In the particular case that I served as an expert witness on, it was a husband and wife. The husband was an engineer, very, very meticulous, very smart, very meticulous. The wife was not an engineer, so she wasn't as meticulous. I was brought in from the wife's perspective to try to convince the husband how to bend to get the case settled. The law firm contacted me and they said, Justin, can you serve in this capacity? Sure enough, I can. So I went in and I generated, in this particular case, financial plans for both the husband and the wife, taking their marital assets and busting them apart and showing each of them what their futures would look like based on what I think the court would rule. So if they went to trial and they went through the whole divorce proceedings, I believe the court would have ruled this way, whatever this way is. I can't get into the details, but I really believe the court would rule this way. So my job as a financial expert is to come in and show both parties how the court will probably or should or could rule and how they can settle this to both of their mutual benefits. That's one case that I was actually brought in on. Financial experts come in many times. I've hired financial experts previously whenever I dealt with some legal things. I hired a very, very knowledgeable CPA to come in and look at the books of the company and see if I was seeing things accurately. I've hired experts with clients to come in and give me valuations on how much a company is worth today and where it should be in the future and how much we should sell that for, how much the court should award the plaintiff in this case for the value of their company. I have been asked by law firms behind the scenes, they've retained me to give them insight on financial matters whenever financial professionals don't do things quite right. So I've served in capacities where I've torn apart life insurance products, and where a life insurance agent maybe tried to sell a product for their own benefit and not in the client's best interest. So I'm able to go in and tear that apart and tell the court, Your Honor, or tell the opposing side, here's what was done and here's why it was done. The reason why an expert witness is brought into play is because the judge is supposed to be blind. You've seen the statue of the female that has a blindfold, and they're holding a set of scales in one hand, and that's supposed to be the ballast and the law book in the other. The judge is supposed to be blind to the ancillary facts of the case, and they're supposed to listen to the case and impartially make a ruling as the law dictates. Many times, though, things can get complicated, so the court system brings in financial experts. I've served as a financial expert. I'm currently being interviewed by 3 different law firms to serve as a financial expert in some pretty interesting matters that are going to hit the news here in East Tennessee. I think it'll be a lot of fun. In order to be a financial expert or an expert witness for financial matters, you've got to know your stuff. You've got to be able to handle attorneys, which are very smart people playing chess games with your mind. You've got to be able to handle them, look at them, tell the facts, nothing but the facts, and help your side of the story or the opposing side of the story get to a settlement. Most attorneys want to settle a case. Most of them don't want to have to go for the judge because you don't know what's going to happen in the courtroom. So the expert witness is there to try to add validity and try to add value to help get a case moved or get somebody to move from one side to the other. So I hope that answers your question there, Floating Love, on that particular thing. For those of you who joined us, we got a lot of people on here right now. If you have a question for me, any financial question, drop it into the comment section right here, and I'll see if I can answer it. If you're like, Justin, I had somebody this week, and I'm going to read some of these questions this week. They said, Justin, I didn't want to put my name on this question. I was a little embarrassed by it. And I was like, oh, okay. So maybe you're like that. And you say, Justin, I want to ask you a question, but I don't want to drop it in the comment section for everybody to see. If that's you, shoot me an email, justin@financiallysimple.com. I will not say your name. You have my word. I'm not going to mention whose name it is, but maybe that your question is a question that somebody else is asking. So we're going to answer some more questions here. So those of you who are on, if you have a question, drop me a line real quick. So this week in an email, I received this this week, and it says, Justin, I'm 65 years old. I just purchased a house. They abbreviate it, so I'm going to read into this some. I'm 65 years old, and I just purchased a house with a 10-year mortgage. Okay, so that's unusual. Many times people will use a 20-year mortgage or a 30-year mortgage. This individual says, I'm 65, just purchased a house with a 10-year mortgage. Is it wise for me to withdraw my 401k funds when I retire in a year to pay off my mortgage? Okay, so behind the scenes, I can't give you more details. They gave me some numbers here. So let's boil it down to the question that we can all deal with. Is it wise to pull money out of our retirement accounts to pay off debt? I actually had a client of mine call me from a different state. We work with clients in about 18 different states right now. He called me this last week and he said, Justin, we're having some medical bills. Should I pull, he actually said, Justin, I want to pull some money out of my retirement account to pay the medical bills off. So you can put whatever question you want to have here. The ultimate question I'm going to ask is, does it make sense to pull money out of our retirement accounts to pay off debt? And the answer is no, it doesn't. And in this particular case, I emailed this fella back and I said, friend, it doesn't make sense. And here's why. The reason for that is, number one, retirement accounts is for retirement income. That's the whole purpose. That's why you've saved money into your 401k or your IRAs or your Roth, whatever it is. It's there for income purposes to get you through retirement whenever you're not producing income anymore yourself. Okay, so that's the primary purpose for it. But whenever we pull money out of our retirement accounts, whenever we're retired, like this fella here is talking about, we're going to pay taxes. In this particular case, he uses the term 401k. He doesn't say he's using a Roth 401k. So that means he's using after-tax dollars. He's using pre-tax dollars to grow an account up so that when he does retire, he can pull the money out of his 401k. And this old fella, he's got some pretty decent income or pretty decent account value in his 401k. He gives it to me in a private message, he said. But whenever we pull out a substantial amount of money, so let's just assume that this fella has a $100,000 mortgage. Or let's talk about the client who said, Justin, I've got a $40,000 medical bill. I want to pull money out of my retirement account to pay off that debt. The problem with that is this: we are going to be taxed and on ordinary income rates whenever we do that. So in this fellow's case, he's over the age of 59, so that's a benefit. He's not going to pay a 10% excise tax, but if he pulls out my theoretic $100,000 plus his Social Security, plus his little bit of income based on the timing of his retirement, he could end up with an income of $170,000 to $180,000. That's going to put you in that 25% tax bracket, which means that in order for him to get a $100,000 net, and his number, by the way, is higher, but in order for him to get $100,000 net, he's going to have to pull out like about $130,000 because he's going to pay a 20% tax, 25% tax on this money. Not to mention in this particular case, he also has state income taxes. Tennessee, we don't have that. So whenever I replied to him, I said, man, your interest rate is low. I mean, it's like a 4% interest rate. If we just continue to pay the payments over time, and I ran the math for him, I said, brother, it doesn't make sense to take all your money out at one time and pay the house off. So I wouldn't do that because of taxes. Take it out of this fellow's case here, and let's throw it over into my client who said, Justin, I need to get $40,000 out of my retirement account to pay off the medical bills. His was actually worse because he's making like $180,000 in income, plus he's under the age of 59 and a half. So because he's under the age of 59 and a half, he's going to pay a 10% excise tax plus ordinary income. So he was going to lose like 40% of his withdrawal value. And I'm like, man, I'm not the sharpest tool in the shed, but we can go out and borrow money cheaper than 40%, man. And it's a medical bill, so we don't have to borrow money. They'll let you put it on a monthly payment of like $100 a month. Really? Yeah, really. So I'm going to tell you as a general rule. Now, there's always exceptions. And what I'm talking about today, everything in this video today is just for educational purposes only. Don't take this as advice. If you're a client, this is not advice to you. Talk specifically with your financial planner, okay? But as a general rule, if you have a retirement account, then it is meant for income in retirement, nothing more. It's not there to help you get out of debt. It's not there for medical emergencies. It's not there even whenever you're fighting a lawsuit. It's there for retirement. And we oftentimes see a big pot of money over here that we could get to real quick. But what we end up doing is we end up robbing our future self for an easy fix today. We rob ourselves way down the future. Like my client who was going to pull out some $60,000 to pay his $40,000 bill out, I ran the math on and said, man, if we just don't touch the money, we're not pulling out 60, we're pulling out $180,000 because of the way the market could potentially return over your life. So to me, it's never makes sense to pull money out of a retirement account because of taxes, because of time value of money, because of a number of factors. So I thought that was an interesting question this week. It's one that I hear in various different ways. Any given week, I'll hear something about like that. So I thought that was interesting to bring forward. So look, there's a lot of folk on here right now. For those of you who are on here, if you have a question, drop in the comments. If you say, Justin, I don't want to ask a public question, I just want to go in and send you a private message, then so be it. So Rebecca, hey Justin, hey Rebecca. If 4 adult siblings inherit an equal amount of an estate, but one of the 4 passes away, does his portion of the estate go to the rest of the siblings or to his children? Gotcha. Can you please do a poo on cam? I don't know what that is, Tammy. No idea. So back to your question, Rebecca. If 4 adults inherit an equal amount on an estate, but one passes away. So we have 4 kids. They inherited some money, but one predeceases the other 3. I think that's what we're talking about here. So predeceased. What happens to the remaining estate? So let's put some math to it. Let's say that someone has let's call it $100,000 estate. That's a simple math for us to do, which means each of the beneficiaries, in this case, 4 kids, should receive $25,000 apiece. Let's keep it simple and just to say it's cash, okay? Each of these people should get $25,000 in cash, but one of the kids, one of the siblings is already gone. What happens to the rest? Excuse me. That's going to come into the question of how is the estate document written? If the lawyer who helped draft the document used the term per stirpes, what that means is if this individual who passed away had beneficiaries, let's say they had 2 kids, then their 25% would flow down to their remaining beneficiaries. So each would get 12.5% of the remaining beneficiaries. Now, if it was per capita, P-E-R-C-A-P-A, then their shares would be shifted over laterally to the remaining beneficiaries, okay? So this is why it's vital whenever you're doing estate planning that you look at the documents which you've written, which your attorney's written. They're going to ask you very specific questions about this. They're going to ask you questions about, hey, in this event, if you have 4 kids and one of them dies and now you got grandbabies here, do you want the money to stay just within your generation, or do you want to use bloodline and push it down to those grandbabies? So, Rebecca, in your case, if it was per stirpes, then that money would flow down and keep on going down the road. If it was per capita, it wouldn't. It gets even more confusing when you're dealing with estate planning is if you have mixed families. Let's say somebody gets a divorce. How do you keep it staying with just in the bloodline? So this is why many times, especially in today's society, families have heartache. We do. I was working not too long ago with a couple that both the husband and wife were split. They had children and then they remarried and so both of them had kids and they remarried. Now they got this blended family. That's an interesting estate case. And so whenever you work in that area of estate planning, and going to your question, Rebecca, then you can, whenever you go to those particular questions, you can plan for those particular ideas. You can plan to make sure that your wishes are carried out. So Rebecca, in your case, if it was per stirpes, it'd flow down. If it was per capita, shifts over, okay? Let's see here. No more questions on this side. Let's go over here to this question I received this week. The question was this. Hey, Justin, I am single. I'm 38 years old with no children. Okay. At first when I read that, I thought they were hitting on me. I'm like, dude, I'm 39, but I'm married. So go easy there, folks. It says I have 2 403B accounts, which tells me they work for a hospital or for a school somewhere, okay? I have 2 403B accounts from previous employers, and a friend mentioned it would be good to consolidate them into my existing Roth IRA in order to get maximum growth out of them. Should I do this? So we're going, you're welcome, Rebecca. So 2 403Bs. So traditionally that's a pre-taxed account. Okay. So the money goes in there pre-taxed. She's asking me, should I move them from these 2 old 403Bs to a Roth IRA? Now, a Roth IRA is an after-tax account. So we put money in there after taxes. So depending on the value, she doesn't tell me the value when she emailed me this. Let's say it was $25,000. If she moves the money from a 403B that's pre-taxed, my assumption, into a Roth IRA that's post-tax or after-tax dollars, if we were to roll over or move that money, that would actually be considered a conversion based on the IRS terms, and we would pay income taxes on that amount of money that we transferred over. So traditionally, for most of the time, I say don't move 401k, 403 but more monies into Roth IRAs. First of all, you have to go into an IRA, then a Roth, but traditionally I like to keep them the same. So if you have pre-tax dollars, keep them as pre-tax dollars. If you have post-tax or Roth IRA monies, keep them as Roth IRA monies. So that's the first answer to the question. The second question she says, or in that statement she says, should I move into an existing Roth IRA in order to get maximum growth? Now that's interesting. The money inside of an IRA or Roth IRA, the type of account, whether it be an IRA or Roth IRA, does not determine the growth of the funds. It's the actual holdings within the account values. Okay. So if you have a conservative IRA and an aggressive Roth IRA, the Roth IRA is going to move faster. If you have an aggressive IRA and a conservative Roth IRA, then the IRA is going to grow faster. So it's not the type of account which gives us the return. That's not what we're after. We're after the taxation on those accounts. The reason why folks use a Roth IRA is because once the money goes into the Roth IRA, it grows tax-free from that point forward, okay? Whereas an IRA, a 401k, a 403b, and a lot of retirement plans grow tax-deferred. So we look at a huge account, but then whenever we retire, if you don't manage your taxes right, you can end up giving a large portion of it to the IRS. So to answer your question, she said, hey, Justice, should I consolidate the two 403bs into my new Roth IRA to get maximum growth? Probably not. Probably not. You probably should keep them in a tax-deferred status, and let's look at your budget and let's see if we can now start saving some money to your Roth IRA on a year-by-year basis. I thought that was an interesting question that came in from last week's Stump Justin. So if you have a question, even though we're going to turn the video off here in a few minutes, if you have a question, you're watching this later on, and you say, hey, man, I got a question for you, you can email me at justin@financiallysimple.com. So this particular question was a result of my podcast. So if you listen to podcasts, check it out on iTunes, Stitcher, Spotify, almost anywhere you want to go to find it. It's financially simple. It's simple, easy. We're dealing with growing the value of your company. The next question that I have here, that I'm going to do one more unless there's another question that pops into the comment feed here today. I'm going to go through one more question. This actually came in the form of a tweet. So a lot of folks are sending me tweets through Twitter. Now, you know, some people don't deal with Twitter. That's fine. But this particular question came in at on Twitter. Okay. I thought it was interesting. So here we go. Justin, I'm 45 years old, and I will be inheriting roughly $300,000 in individual stocks. First of all, congratulations. That's awesome. 45 years old to get $300,000 in individual stocks. That's awesome. I actually, right there, I stopped and asked the question to the individual. I said, is this a non-qualified account? In other words, is it part of an IRA or is it part of a Roth IRA? And if it's part of an IRA or Roth IRA, then we have some different planning. And they said, no, it's not. It's just was in my parents' name. And I'm going to be inheriting that as per their deceased. And I said, I'm sorry that you lost your parents, but let's deal with your question. So whenever the parents died in this particular case, the stocks get what's called a step up in basis, meaning there's not going to be much taxes due on this account based on mine and this individual's conversation. And he said, hey, I need to live off this money, but I'd like to move out into the country. I'd like to build about an 800 square foot home on a piece of land in Wyoming. I was like, sweet, man, I love that. We were talking about it. Because I just want to find some land, build a little house on it. He goes, but I'm disabled. I'm not quite eligible for Social Security benefits. I'm like, okay, I see where you're going with the question. He's like, man, is there a way to invest the money, to invest this $300,000 to where it can provide me income and not affect any potential Social Security disability earnings? And I said, yeah, there is. So now I don't have time today to get off into how the IRS or the Social Security Administration deals with disability, but I want to deal with more his specific question is, how would you invest the money to provide me income for the rest of my life? So we first laid out some ground rules and we said, look, $300,000, if we just made 5%, that's a simple number that most of us can calculate in our head. If we just had 5% earnings, then we would get about $15,000 a year in income off of this account without spending down the account. We want the $300,000 to stay. We want it to theoretically grow a little bit, but we want to take some income off the account. I call it in my office, this is not offensive by any means, but I call it my little old lady account. So whenever we had, like my mom, she's not a little old lady, she sees this, she's going to say, son, I'm not a little old lady. But no, you want to have a little account that's going to provide income whenever we retire, okay? And that's what this individual is talking about. Now he's too young. He's 45. So I can't pull 5% off this account. I can only pull like 3.5%, 4% because we got to have some growth to outpace inflation long-term for the next few years. So I said, yeah, man, we can invest the dollars so that we can get a little bit of growth and a little bit of income out of the market. He said, well, what about the risk? I'm like, well, We have multiple different risks, and through building a diversified portfolio, we can address the various risks, whether it be what's called systemic or asystemic risk or non-systemic risk. We can deal with those. We can deal with inflation risk. We can deal with bond risk. We can deal with cash risk. We can deal with market risk, currency risk, exchange rate risk. We can deal with tariffs. We can deal with all these different risks through a diversified portfolio. And so he and I began looking through it. And he said, Justin, I'm single, man. I don't have any dependents. This is all I got. I cannot lose it. So then we started looking at what happens if he takes a safe position and just dumps it in cash and leaves it in cash, or buys a very safe CD. We got to look and say, man, you can't. You don't have enough assets to pull that off. So maybe you're like this individual. He's 45 years old, fixing to inherit some money. I recently inherited a little bit of money from one of my dearly loved family members who passed away. What do you do whenever you inherit money? And that was the other question that he and I were talking about here. So maybe you have the question. Maybe you're someone out there and you're like, man, Justin, I'm getting ready to inherit a little bit of cash. I'm going to tell you what I did. You pay off any debts that you want paid off, you invest some, and you spend some. Our family members leave us money so that we can better ourselves and enjoy life. Pay off some debts, invest some money, and spend some money. I'm going to buy, me and Miss Emily, when Miss Emily's getting, first of all, her couch, someone just texted me on my phone here, and they said, Justin, you need to buy a new car and get the mouse out your car that I talked about earlier in the episode. You go back and watch it. It's pretty funny. But I'm going to buy us a new piano. There's 3 people in our family who play the piano. I think I was going to buy us a new grand piano. And so every time we play it, we'll think about our family member who helped buy this for us. I mean, that's what it's about. So guys, I'm out of time. I'm out of brain power. I'm out of everything. It's 5 o'clock on Friday. Let's get out of the office. If you have any questions as you watch this throughout this week, next week, shoot me an email, Justin at Financially Simple. Put on the heading Stump Justin. Drop me an email. If it's a great question like some of these, I'll bring it on the air next week. Every Friday about 4:30, I'm going to deal with questions that I get during the week. Or maybe if you're here like Rebecca did, Rebecca asked a really good question about estates. Maybe you have a question like Rebecca and you want to join us at 4:30 on Fridays, so be it. You know, like I say every week, I say this in my podcast, I say it in my emails, I say it in my newsletters, I say it on the blog, I say it in the videos. Life is hard. It is. Life is good, and life can be frustrating beyond measure. Money doesn't have to be. Folks, let's continue to make our lives at least financially simple. Y'all have a blessed weekend.